Hello, welcome to Group C4 core concepts related to cash distributions and capital structure. Difference between the dividend payout ratio, retention ratio, and dividend yield is that the ratios show how a company allocates profits, whether through dividends to shareholders or reinvestment for growth, and how investors measure income return from stock ownership. Let's talk about ratios. Dividend payout ratio is calculated by DPS divided by EPS, which means percent of earnings paid out as dividends, indicate firm's distribution policy. Retention ratio calculated by 1 minus payout ratio. It means that percent of earnings retained from reinvestment and growth. The final one is dividend yield. Annual dividend divided by stock price. It means investors' income return from dividends relative to stock price. Let's talk a little bit more about ratios. Example inside. High payout means more cash to shareholders. High retention means focus on future expansion. High yield means strong income appeal for investors. Managerial finance will. Those ratios reveal the balance between growth and income strategy. So managers use them to maintain an optimal capital structure and maximize shareholder value. So effective dividend policy blends current returns with long-term reinvestment goals. The IWT capital budget for upcoming year is set as 112.5 million with an 80% equity and 20% debt structure. The expected net income is 140 million, leading to a dividend payout ratio of 35.71% and for a forecasted dividend per share, which called DPS, of 50 cents per share. However, income to 90 millions, the company would not generate enough residual net income for dividends. Therefore, there is no forecasted DPS. On the other hand, if net income rises to 160 millions, the residual net income available for dividends would be 70 million, allowing for a higher DPS of a 43.75%. Continue on capital budget analysis, investment options, and residual distribution policy. Investment options directly impact the company's residual distribution policy and payout ratio. Also, the cost and availability of alternative capital resources are critical factors for company as well. We are going to dive in more about capital's budget analysis. So the residual policy, there are some pro and con about this. The residual policy allows companies to distribute cash to shareholders only after meeting or investment opportunities. Signals positive future prospects to investors and minimizes agency costs. Can deter income-focused investors and lead to stock price volatility, can alienate investors who prefer regular income, can be perceived as a lacking profitable investment opportunities.